So welcome to our bite-sized Wednesdays at the Vermont Community Loan Fund. These are just very quick, short workshops and presentations meant to give our borrowers and clients an opportunity to find out a little bit more about different topics. Today, the topic is really about loan readiness. So are you loan ready? We're going to take you through and just talk about what some of the things that we as lenders and a lending institution, as well as business advisors, are looking to support potential borrowers and borrowers with. And I should pause actually and remind everybody, or let everybody know, introduce myself. My name is Elena Gustavson. I'm the Director of Business Resources. And we also have on the phone Dan Winslow, who's our Director of Business Lending.
Hello, everyone.
So the topics we're going to cover today, so the key steps for loan readiness, best practices include formalizing your business finances, understanding your capital needs, exploring your financing options, and preparing for the application process. The topics are listed here. Both, we're going to talk a little bit about formalizing your business and business finances. Hopefully most everybody has done that, but if you've not done that, we'll take you through just a checklist. We'll talk and discuss about key financial documents and why those are important. We'll also, just to touch on evaluating whether or not you need capital or whether or not you want to take on debt capital for your business. We'll just talk about the capital continuum for small businesses. We're also going to touch on predatory lending because as a lending institution, we do run into that quite a bit where clients of ours do fall prey to predatory lending. We'll talk about what to consider when evaluating a loan, the types of supporting documents commonly required for your loan application, and the way that our lenders evaluate income, debt, and cash, as well as the way they evaluate your credit score, collateral, connections, and conditions. And then lastly, we'll give you a checklist of what is typically, what you can typically expect in an application package. So starting off with formalizing your business, again, hopefully most everybody's done that. If not, the steps that you want to take is to kind of, once you've decided you're going to do your business, you want to start with writing your business plan. You then want to choose a legal structure. You want to file a DBA or register your name with the Secretary of State. DBA stands for Doing Business As. Make sure you get your tax ID and an EIN, which stands for Employer Identification Number. You want to set up a business bank account. Again, we want you to keep your personal accounts and your business accounts separate from each other. And then if there are any licenses or permits that you need to be registering for, whether it's because of the industry that you're in, the town or the city that you're in, make sure you do those as well. This is what we would generally call formalizing your business. Now, most lenders, as you know, just a note that we're making up here is that most lenders need to see proof that most, if not all of these steps have been taken before they can actually lend you money. That applies not just to VCLF, but to any lender that you were looking to borrow money from. And then in addition, formalizing your business just generally has many benefits outside of accessing that debt capital. And that includes growth opportunities. So when your business has been formalized, you can then create partnerships with others. You can get grants. There are lots of things that you can do to then grow or move your business forward. Next, when we talk about formalizing your business, there's also this aspect of formalizing your business finances. And the way that we encompass that is talking about that as your financial documents. And the key financial documents that any business should have access to or should have created reports for, whether that's through QuickBooks, whether that's through a spreadsheet, are these like four that you essentially want to have. So you want to have a profit and loss statement, sometimes called an income statement. A profit and loss is generally a summary of your business revenues, your expenses. It gives you the financial picture of your business over a specific period of time. Typically, it's over the course of maybe your last fiscal year or your last calendar year, or it might just be for the month. The balance sheet, it's a snapshot of your businesses, your assets, the things that you own, liabilities, which are the things that you owe, and equity, which is essentially what you have invested in the business altogether. A balance sheet is a snapshot in a very specific amount of time. So let's say today you were asked to generate a balance sheet and you're using QuickBooks. You would input today's date, and the balance sheet that was generated would be reflective of what is currently in your books today, or which your books are hopefully up to date. So will also be reflective of currently what your current assets, your liabilities, and your equity are. The third statement, financial statement or document that's very important, is your cash flow statement. So a cash flow statement is something that summarizes those changes in your business's liquidity, or what we might also say cash, over another specific period of time. So if you have a profit and loss statement that's over the course of 1 year, you have a balance sheet that's been generated today, then your cash flow statement should mimic the same amount of time as your profit and loss. So if your profit and loss is last fiscal year, your cash flow statement should also be last fiscal year. And that will show a lender exactly how your cash account or the cash in your business has changed over the course of time. The fourth document is something called financial projections. It's also called cash flow projections. And that is the estimated cash flow statement. So the cash flow statement that you just generated, you then project out ahead 12 to 24 months and do your very best to identify what kind of cash standing or what kind of cash assets you will have in your account over the next 12 to 24. So think of a cash flow statement as something that tells you what your past cash flow has been, and your financial projections or your cash flow projections is what your cash flow will be. It's the future. So when you have gone through all the steps of formalizing your business, including that business plan, registering, registering you're doing business as, you have formalized your financial documents, that's when many businesses start to think about whether or not they want to take on a loan. Now, generally, when you are a brand new business, most people aren't necessarily starting with a loan. So like a new or startup business might be yourself. You might be pulling out of your savings in your retirement. You might be using credit cards. HELOC stands for a home equity line of credit. You just might be bootstrapping it. So just paying it out of your business account as you have cash. And sometimes it's sweat equity. The positives of doing it this way with either yourself or if you have a partner with your partner is that this is almost entirely debt-free. And this ultimately, because you're not taking on debt, it means you're increasing the equity in your business. The problem with this, or what some of the drawbacks, not that it's a problem, but one of the challenges of doing it this way is that you are minimizing your own personal cash reserves and or liquid assets. And that's really what I mean is cash reserves. So anything in your savings or your retirement accounts. It can also increase the time it takes you to get your business going, to really getting it started, because you're limited by the amount of cash that you have on hand. Another way that newer startup businesses will get themselves going is they might borrow or get gifts from friends or family. So personal loans, gifts. Crowdfunding is something that we're seeing more and more of because of the platforms that are out there, and those can either be successful or not successful. And again, the great thing about relying on friends and family is that it is technically risk-free capital because you have relationships with those people and you can typically have repayment terms that are flexible. They might be actual gifts so that you never have to pay them back. But one of the drawbacks, a big drawback, I think that you cannot ignore, is that it can potentially be very risky to your relationships. And then also personal loans. So if somebody in your family loans you the money, that is still counted as a liability on your balance sheet. And when you do decide at some point in the future, you might want to take on a loan for your business, that can be counted as a liability against you. In other words, it can count as additional debt. It's a debt to income ratio that we can talk more about. And then on the other side of this, we have established or mature, right? So this area over here where traditional banks are, and the value of being an established or mature business, one that's been around for a while, is you typically have already established business credit. There's some maturity in your business. You're kind of cruising along. And that's when banks like to kind of hang out with you. And Dan can correct me if I'm wrong, but I think typically most traditional banks, things have changed a little bit, but most traditional banks like to start talking to you as a business when you're going to borrow more than $200,000. The benefits of a traditional bank is that they are using market interest rates. So their interest rates tend to be quite low. They also have varying and flexible repayment terms depending on the type of loan you're going to get. And then again, these aren't very suitable for new or growing businesses, which is where most of you are if you happen to be in this workshop today. So over here, what I want to do is just focus on these middle folks, which is growing business. So for most growing businesses, what that is basically defined is that you're established, or you're maybe 1 or 2 years into your business. It's been formalized. You've done what you can with your own cash savings, or maybe you're growing quickly enough that you would like to work with a lender, knowing that you're not quite ready to work with a traditional lender. What we end up seeing is quite a few people kind of move into this alternative institutional lenders or alternative lenders. And that's for factoring companies. They'll use credit cards. Sometimes credit cards will give you loans, payday loans, merchant cash advance providers. And this can be very beneficial for certain types of industries and certain types of companies. They're very flexible, they're fast, they're easy, they're all over the place. So you see them on all kinds of commercials. The problem that we see, and this is where predatory lending hangs out in this space. Not all of these folks are predatory lenders, clearly, but that's where we start to see quite a few predatory lenders hanging out in this particular space, where they call themselves, well, payday loans actually are problematic in a lot of different ways, but merchant cash advance providers, that's where we see a lot of predatory lenders hanging out. So it's something to be careful of. And one of the things that are a problem with these alternative lending types of mechanisms is that they tend to have less transparent policies, and it's fairly high cost that's paired with short repayment terms. So the less transparent policies, if you can imagine, it feels a little bit like you are being sold something constantly when you are talking with one of these lenders. And that's even true of some of the more reputable lenders who you might have heard of, like I can't even recall right now. I think American Express is actually one that quite a few small businesses use, but they tend to be quite high cost. You have to pay the loan back very quickly, a fairly short amount of time, usually less than 3 years, maybe even less, 2 years or 1 year. And you have to be the one who's ready to ask the questions. You need to know what questions to ask in order to fully understand what their policies are. So those are just some of and we'll talk a little bit more about how to avoid predatory lenders in the next slide. But then the other space, the other alternative space for a growing business, and this can also be true for a new or a startup business, is a community lender. Now, those are micro lenders, meaning that they loan, I think it's, Dan, I might need you to help me out. What constitutes a micro lender?
Usually anyone who's lending from 1,000 up to 50,000, though some micro lenders will lend below 1,000. In our Vermont Community Loan Fund, we usually look for a minimum of at least $1,000.
Got it. Okay. So micro lender is somebody who's lending generally between 1,000 and 50,000. There's SBA. SBA stands for the Small Business Advisory. There's SBA lenders. CDFIs, which is what Vermont Community Loan Fund is. It's a community development financial institution. And then credit unions. So these are lenders that tend to be based in your community. They have a community investment or interest in the people that are there. And one of the things that's so fantastic about these types of community lenders is that they are flexible, they are transparent. The interest rates can be on the lower side, not usually lower or even close to what a traditional bank can charge you, but will certainly be lower than many of these alternative lenders that people tend to find online, or the interest rates can go as high as average. So Dan, is it right that our interest rates, depending on what loan program you're in, will be anywhere from 3% to 6% on average?
Yeah, for our special sources of funds that we can get investors to support us with lower cost capital for, we can get down to 3%. That is true. Our standard rate right now is 6.75%.
6.75%.
And I'll always be the first to admit a bank is going to be able to outperform us on a standard interest rate. Just generally what we're finding right now is banks, like you mentioned, Alina, will usually need you to be in the 6 figures before high 5 figures before they'll consider a relationship. And they usually want to see you in business for 2 years.
Got it. Yeah, that's great. Thank you. So this one, I wasn't sure how much to include in this particular sign, but again, because predatory lending is something that that many small business owners come up against, and even not even a small business owner, just an individual. These are some of this is a great graphic that I stole or borrowed from Axion Opportunity Fund, which has lots of great resources. They're a national resource for small business owners. But these are some of the things that they have seen as the 7 warning signs. So quickly, just one of the ways that you're going to tackle some of this is that number one, when you have unclear pricing and terms, if it's not clear to you, if people are not responding to your questions, if you don't understand it, do not sign it. Do not take on that loan. That second, sign brokers who will not disclose extra fees or extra interest, sometimes called a kickback. It's also sometimes called a yield spread premium, or any other additional fees that don't make sense to you. Or if those brokers are pushing or kind of cajoling or even bullying you into accepting something that you're not comfortable with, those are huge red flags. Generally, brokers and lenders who are reputable are going to be upfront, they're going to be transparent, and they're going to be honest. So if you are not getting that from anyone you are working with when it comes to a loan, you should just walk away. So prepayment penalties. Lenders make money on interest. We make money off of interest. Traditional banks make money off of interest. Alternative lenders also make money off of interest. So there can be some naturally occurring goals between the borrower and the lender that are very naturally at odds with each other, because as a borrower, you tend to want to pay off your loan as quickly as possible to reduce how much interest you're paying. Or you want to try to have the lowest interest rate as possible. As a lender, knowing that that's where a lender makes their money or their income, we want to get as much as we can out of that. So, or at least naturally you would think so. Where things become tricky is if you're working with the lender that charges you a prepayment penalty. So in other words, if you pay your loan off early and they charge you a fee, it's not unusual to have a very small fee attached to that. You'll find that to be true with home equity lines of credit. If you pay your line of credit off, even with the traditional bank, if you pay that off early, like within less than 3 years, maybe less than 5 years, they might charge you $500 or $600 for paying it off early. But what some of these predatory lenders will do is charge huge prepayment fees, like the cost of your loan is what they'll essentially charge you for trying to pay it off early, or anything even that seems out of whack or seems too high to you. If there's any kind of prepayment penalty, that is a red flag. So be very cautious if a lender agrees. Here's another thing, if they agree to let you pay off your loan in exchange for you borrowing more money. That is something else that happens as well. The fourth one, if approval is too easy. So everybody wants a loan that's really quick. They don't want to have to jump through all the hoops. It's a big deal to get a loan. But a fast and easy approval with very little or basically no required documentation is a huge red flag. A reputable lender, anybody, and Dan can attest to this, if he is going to loan you money, he is going to require documentation. And for Dan, that means he is doing his due diligence. He wants to be sure that your business is viable because he wants to see you be successful at your business. If you have a lender that does not require financial statements, doesn't require any kind of statement about how you're going to use the loan, doesn't require what you're going to do with your, understanding how your business works, that is another big red flag, because what that essentially is going to tell you is that they're going to make their money whether or not you are successful at your business. And that's usually through very high interest rates or fees. So number 5, abnormal payment structures. So typical loan repayments are you pay once a month. You know what your payment is going to be, and you know for how long that you will be paying that loan back. An abnormal payment structure is where they are debiting your account, like your checking account, every day, every month, every week. Or those payments will vary from day to day, from week to week, from month to month. If you see that this is how their payment structure is set up, do not agree to do this. It's very important for you as a borrower to understand exactly how much you owe, how much you'll be paying, how much of that is towards your interest, and how much of that is towards your principal. That is your right to know that as a borrower. Short-term loans. So short-term loans are another thing. Is what we call a payday loan, a tax refund loan. And then this is a new one that I've heard of, is a car title loan. These are basically cash advances. They have extraordinarily high APRs, or annual percentage rates. And they have typically huge costly penalties attached to them. A short-term loan, a payday loan, get your cash right now. They are absolutely counting on you not being able to pay them back on time. And therefore, they can start just charging tons and tons of money. The problem with these short-term loan companies is that they tend to fall outside of typical regulation, which means that the laws that are there to protect you as a consumer and a borrower don't always apply to these guys. So it's important to stay away from these types of loans. And this is where we see an immense amount of predatory lending. And then the very last one, and this is true of any borrower, but specifically is a warning sign, is if your lender or the staff that you're working with just will not answer your questions. They'll dodge them, they'll ignore them, particularly when it has anything to do with terms or cost, or they'll deflect. That is a red sign that they're not interested in your success, and therefore they are not they're not interested in your business doing well, and they are going to try to get money some other way. That's another warning sign. Okay, so moving right along, once you have gotten to this point where you are formalized, you now know how to avoid a predatory lender, you've got all your finances in order, and you have decided you're going to go ahead and get a loan for your business. One of the things that, not one of the things, but here's a list of some things that you yourself should consider when you are evaluating a loan or a lender. So you understand what the interest rates and the fees are, understand what the total cost of borrowing is. So people don't always understand that there are often costs to applying credit checks. Sometimes there are costs associated with that. So there's costs that are attached to applying for a loan that you should understand before you apply. If you can, as you're talking to your lender or to your loan administrator, talk to them about what the payment amount might be or the frequency. Sometimes that's not fully understood until towards the end of the lending, until the underwriting process. Try to find out what the approval timeline might be and what kind of documentation will be required. And then understand whether or not collateral or personal guarantee will be required, which it almost always is, that you have some kind of asset to secure the loan. And if not that, or in addition to that, be a personal guarantee that's required. Dan, is there anything you want to add to that list?
I think those are the key aspects. I would say on interest rates, one thing we've seen that predatory lenders do is they'll say interest rate per month instead of annualized. So just be aware and check for that when you're looking over documents, particularly if you're talking to a rapid finance company for some reason.
Oh, that's great. That I didn't realize that. Thank you. And then just off to the side, what I call our BRC pro tips, so the Business Resource Center. Our advisors might also advise you if you're working with us as a potential borrower before you apply, is to, once we help you build out your cash flow statement and your cash flow projections, one thing to keep in mind, if possible, whether it's with us or with another lender, is to try to arrange to make your payments during the part of the month when your cash flow is at its very highest, so that you can be sure you know that you will be able to pay that loan back that month. You also want to think about how much you can actually afford to borrow, so that those loan payments don't eat into your working capital, which is, you know, what you need to run your business day to day, or into your cash reserve. So that's why you want to do quite a bit of planning ahead of time. And then always check your credit report before applying for a loan. Dan, I don't know if you run into this. I don't know how many borrowers are often surprised by their credit score. But we try to encourage folks to understand what is on their credit report before they apply.
Yeah, we've made a general practice of going through the credit report specifically with everyone who applies now. And I'd say about one time in 6 or 7, we find there's a mistake on there that the borrower or the applicant should work to correct with their credit reporting agency.
Yeah, and Dan and his team that work with potential borrowers on that is not something that all lenders will do. They'll just pull your credit report and that's it. And they'll never discuss it with you again. So it is important that if you are going to apply for a loan, any loan, that you take advantage of getting that free credit report every year so you can see what's on your report. A score is a system. There's several different systems that are out there, and we'll actually talk about that a little bit more later on, or in just a moment or two. But accessing your credit report once a year, it's free. Otherwise, it might cost you as much as $13. But making sure that you know exactly what's on there, that you can flag or discuss or clear any discrepancies or problems that you see on your credit report is very important, just in general, for your own personal financial health, because it will impact your business. Okay, we're almost done. Preparing for the application process. So after you've done all that work, it's a lot, and I know that it's a lot, but it is so important, just as a business owner, to help you think about what kind of debt you want to take on. Once you do take all those steps, you've evaluated your loan capacity, you've decided who you're going to go with a lender, then you actually prepare for the application process. It's a long process to get to this point, and then once you get to the process of applying, it makes it go so much more smoothly. And the more smoothly you can make the application process on your end, it really sets you up for better success to get that loan approved. So I do at some point want to pause in here and give Dan a chance to talk about this some more. But fundamentally, at the end of the day, what a lender is looking for is whether or not you can repay the loan. So underwriting, which you might hear us talk about here or there, is fundamentally when a lender is evaluating your ability to repay based on both financial and non-financial characteristics. So we're going to talk about what some of those characteristics are. Dan, anything you want to throw in there? I think that about sums up what a lender's trying to figure out, right?
Yeah, I'll have more to say on the financial and non-financial characteristics.
Okay, great. So I won't say too much. I want to let Dan say this, but the one thing that I think is overall about all of this is you need to prove that you have enough money coming in, or that you have enough reserves that you can make the loan payment on top of or in addition to all your other expenses. And then Dan, I'll pause so you can talk a little bit about these financial characteristics as a lender, what you're looking for.
Yeah. So speaking for our role in Vermont Community Loan Fund, our goal is to try to promote commercial business activity. So business revenue is the most important factor for us, and trying to determine the income that will help pay back a loan. We certainly do evaluate outside wages or household income, but your actual revenue as a business, we're a mission-based organization. We want to be creating business activity in Vermont. So revenue is a pretty good determination of that in a lot of ways for how the loan's going to get paid back. In terms of your debts, we do look at what mortgages you have, but also if you're renting a place, what rental costs you have associated with it. So we do evaluate your personal financial situation. We look at what other loans you have and what those cost you a month. And we do look at credit card balances, and particularly credit card interest rates. It's been an area of increasing review on our part, I guess, to see credit card rates have been creeping up lately. So we're trying to keep an eye on that and make sure that at least the business plan allows for, income that will help be able to pay for some of the more expensive debts like credit cards, and that we can help you develop a plan to get those paid off and work through those. And then in regards to your cash position, we do evaluate what you have from your business accounts and perhaps your personal accounts to determine if there's any kind of possibility for you to make a down payment or an equity contribution of your own to the financing, or if you're in a position where we're having to look to do more of that with debt. And so at the end of the day, the most important thing is cash flow, cash flow, cash flow. Seeing that the business has cash flow to pay the debt, that whatever we're lending for will either improve your costs or reduce your costs or improve your revenues. Those are the most critical for making sure we're setting you up in a position to succeed.
Awesome. Dan, thank you so much. Cash flow, cash flow, cash flow. Okay, here's another one.
Yeah, so I need to take a second to talk about credit score, because a lot of more traditional lenders out there might use credit score as a gate. Though what we find, and Vermont Community Loan Fund does not use credit score as a gate or requirement. We do evaluate what's in the report, but often what we're finding is folks who have medical debt or other things, that doesn't necessarily affect the strength of their business proposal or how strong their business's financial position is. And so we're finding ourselves increasingly looking past medical debt to more evaluate what's going on with the person and how it relates to the business. And medical debt hasn't been a good indicator to us of how successful someone's business is going to be. So that's, for whatever that's worth, we'll put that out there. In regards to collateral requirements, that depends on how much we're borrowing for. On microloans, we can be a little more flexible on our collateral requirements. But when we talk about collateral, we're talking about equipment, we're talking about inventory, accounts receivable, things like that, that are tangible assets, vehicles that we can use to help secure a loan and make sure that we can comply with our lending policies, which will be more liberal than traditional lenders, but we still do need to protect ourselves and protect our investors and those who fund us. And that secondary and tertiary source or repayment of collateral, if the business revenue isn't enough, is still important. How long you've been in business, connections. So we are increasingly working with a good number of startups, obviously, that can be considered to have a higher risk than someone with a more established track record. But what's most important is there a plausible and reasonable, achievable plan for how the business is going to ramp up and develop its financial projections. And I encourage folks to work with our Business Resource Center or with other entities around the state to help develop business plans, whether it's SCORE or VTSBDC, Center for Women's Enterprise, et cetera. To develop that business plan and those projections and find those advisory supports for yourself. And in terms of experience in the industry under conditions, it's okay to move into a new industry, but we need to understand what's your human capital, what's your skill set, how are you going to manage in a new field, if it's a new field or if an existing field, how will your past experiences help set you up to succeed? And just the strongest applications for a loan will be those that have a clear purpose that's going to help them. The loan will help you expand your business or improve or reduce your cost structure. And so those are going to be what is the most successful, and those that will have the strongest plans.
Yeah. And then one thing to circle back to what you were saying, Dan, about the credit score, and how we don't necessarily, some banks will just not even take an application if your credit score is low. And in our case, we use it as part of our evaluation. So lenders, so like in your case, Dan, you'll use that to evaluate the risk of a loan. You won't necessarily say yes or no, right?
It's not a litmus test by any means. We evaluate what's in the report. And that's why I talk about why it's important we go over your report with you, because like I said, we're often seeing, wait a minute, I thought I had that loan paid off, or wait a minute, I don't ever remember seeing that debt. And so those are important things to figure out that can help affect your score. And one thing I'll quickly mention is we do report any loans that are personally guaranteed. We'll report those to the credit bureaus, ideally with the goal of helping people build their score so that in the future they are more attractive to a traditional lender.
Yeah. And one of the things that you can do, and we are going to do a kind of credit report, credit building workshop in a couple of weeks. But one of the things that you can do as a potential borrower, as you are thinking about getting a loan, is that if you can grab that report ahead of time before you apply and really kind of come through it and look at it, you can also submit written statements or be prepared to explain why your report looks the way that it does. I think it would be correct to say that lenders like to know that you're taking a proactive approach to handling your credit or addressing problems. We have all had problems in the past. Very few of us have perfect credit scores. And so it is very important to be proactive and to show that you're not ignoring it, but you're really looking to take care of it.
Agreed.
Yeah. Okay, I'm going to move on to the next slide because we are running out of time here. So generally the core pieces of a loan application, I'm going to pause here because I'm not a lender, I'm a business advisor, but I'll give Dan, if you want to just review this real quickly.
Absolutely. Some of the key things we look at are your tax returns, both personal and business, just to get a sense, one, of your personal financial position, and two, the historical financial position of the business, if there is a historical record. We love looking at your year-to-date results because the most current information can really help kind of paint the picture for where your business is at right now. And that can come from things such as profit and loss statements, balance sheet, or bank statements. And looking at your own personal financial statement, we'll look at, as we mentioned, your personal assets, such as any personal credit card debt or things like that, compared to your liabilities like credit card debt. I think I misspoke there. So assets would be things like vehicles, cash, any investment accounts you have, such as that. We do, like I say, pull a credit report on everyone. We'll go over that report with you, and we'll discuss what's in it and how that affects your position. And in terms of background checks, we do search certain federal databases just to make sure you haven't defaulted on any federal debt. And if you're in specific industries such as childcare, those may have more specific industry requirements to get licensed, but generally we just determine that you are licensed. And then very critical, a plan for how you're going to deploy the loan funds and for what purposes. So how much for equipment, what specific equipment, how much for your working capital or operating in reserve. Knowing all of that going in is very important.
Yeah. Okay. If you have any questions about anything that we shown in this workshop, you are welcome to reach out to any of us here on this calling card or this business card. Dan Winslow, he's our Director of Business Lending and Early Care and Learning Departments or Programs. And he is also one of our loan officers. We also have Heather Hurlbert and Emma Enoch Our business advisors are Max Kraus, Ben Green, and myself. You can get a hold of us either through email or you can call our main line and be directed to one of our phones. So I'm going to go ahead and stop recording. Thank you all very much.
Thank you, Ron.